Chevron Corporation, stock ticker CVX, is currently trading at $152. Year to date, they are down 12.5%, and over the last year, they are down 13.7%. Chevron are growing production organically and have recently acquired PDC Energy. And in this video, I want to take a closer look at the intrinsic value of Chevron Corporation to see whether or not it's attractive at the current levels, both for growth and for income. And to do that, we have our usual stock screener where we punch in CVX and wait for everything to auto-populate. We also just zoom in a bit so it's a little bit easier to see. The PE non-GAAP forward ratio is around 10, which is way below its 5-year average, but that has also been artificially raised quite high due to some of the oil prices the last couple of years. The dividend yield is around 4% and the payout ratio is 31%. So looking pretty good here. It has a short interest very low, and the 52-week low is 132 and the 52-week high is 189. The analyst target price is 188. So they are expecting there's a bit room to grow here. EPS growth 37% and the return on equity 22%, looking really good. So if we jump into our dividend data tab and then zoom in a little bit more, you can see here that the dividend has grown quite steadily. You can see back from all the different years, it has risen quite a lot, around the 3, 6, 8, 3%, 7%, and so on. So an average dividend growth rate over the last 10 years of 4.5%. If you scroll down a little bit to the dividend data here, you can see that according to dividend yield theory, it should actually be a bit overvalued at the current time. You can see here it's down in the red. Whenever we move above the line into the blue area, that is when there is a potential undervalue to the stock. But right now we are in the red. But we do have a lot of different valuation models to help us find the intrinsic value. The first one is the discounted cash flow model, where we do take the free cash flow from the different years. We then use an applied growth rate to project those into the future. As you can see, the average growth rate over the last couple of years was 133%, boosted really highly in 2021, 1,176%. So I took a very conservative and common growth rate of around 5%. We then project the cash flow in the future out 10 years until the terminal value. We then discount those back in a present value using a discount rate of 9%, combining cash and cash equivalents and the total debt from Chevron with the shares outstanding. We then arrive at a fair value of $350. Next model is the dividend discount model, where we do take the dividend payout from the different years. We then apply a growth rate to those dividends into the future, combine that with a weighted average cost of capital of close to 9, and I have used an applied growth rate of 6%, which is roughly in line with the average growth rate. We then have an intrinsic value of $220. Multiples valuation, where we take some comparable companies to Chevron, such as Shell, Exxon, and so on. We then use those EPS and PE multiples to find a common EPS for Chevron, which gives a stock price of $82. The next one is the price to earnings variation, where we do take the PE ratio of the different years. We then find a 5-year average, combine that with the EPS, you arrive at an intrinsic value of $252. But if you take a close look here, you can see that the intrinsic or the EPS in 2023 was 18.5 compared to all the other years that are a bit lower. So if we do use the intrinsic value of 2022, it is around $111. Next one is the Graham's advice variation model, where we do take the EPS from Chevron, combine that with PE of a no-through company, combine it with the expected growth rate in the future, a average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. You can then arrive at an intrinsic value. In this case, analysts expect it to grow negatively, so the intrinsic value will thus be negative, and we will be thus excluding the Graham's advice valuation model later in the summary. Our next one up is the free cash flow valuation method, where we take the price to free cash flow ratio from the different years. We then average the last 5 years together, combine that with the free cash flow per share. We then arrive at an intrinsic value of roughly $122. The last one is the Peter Lynch model, where we do take the growth rate, the dividend yield, and the PE ratio of the company and combine all those together to calculate an intrinsic value. And if you haven't seen the video I've done on doing this model, you can find it in the playlist. In this case, the growth rate is again negative and intrinsic value will then be negative. So I have excluded it from these calculations. Before we jump into the summary, thank you so much for watching. And if you haven't done so already, please subscribe to the channel and let's get right into the summary, where we have all our different models. You can see here that we do have Graham's that I have chosen to punch out since it's negative. There's also the Peter Lynch valuation that shows up that didn't give anything, so also exclude that just in case, you can see the average intrinsic value is around $205, roughly in line with the analyst target price, around 10% higher. With the current price being $152, it could potentially be there's an average discount of 26%. So using these calculations, and that gives it a pretty high margin of safety of, let's say, maybe 20%, we arrive at an acceptable buy price of $152, also above the current price. So if we try an even higher one with a margin of safety of, let's say, 30%, there's a slight dip to be had of just under 10% before it reaches an acceptable buy price. So if you do believe in Chevron's long-term outlook, I think it could be a pretty okay time at the current time to buy in, because you can see here there is roughly a margin of safety of 25% compared to the calculated intrinsic value. Thank you so much for watching, and I'll be seeing you in the next video.